So after income statement, we have prepared the trading account and profit and loss account in the income statement. Through the trading account, we calculate the gross profit or gross loss, which is transferred to profit and loss account, and thereafter from profit and loss account we find out the net profit or net loss. So income statement is completed. Thereafter we will prepare the balance sheet, positional statement. Balance sheet is prepared on a particular date, as on date. So information of all assets and liability will be reflected in balance sheet. Means real account and personal account balance will be reflected in the balance sheet. Real account and personal account. Real account, debit balance, then asset side, and credit balance, then liability side. Personal account, debit balance, asset side, personal account, credit balance, liability side. Okay, so real account and personal account is reflected in the balance sheet. All assets and liability will be in the balance sheet. So coming to the liability side. Okay, coming to the liability side. So first liability, suppose that the capital, start with the capital. Capital is the liability, it's a owner's liability, it's a owner's fund. So capital, you write the capital information inside, then you add net profit to the capital, net profit if any, add the net profit. Okay, if there is a net loss, instead of net profit the net loss is there, then you deduct the net loss from capital. Okay, less drawings, which is proprietor. If it withdraw the amount for personal use, then you deduct the drawings. Drawings may be your income tax, amount withdrawn for personal use, goods withdrawn for personal use, or any services of the business is availed by the proprietor for personal use, that is drawing. So if there is any drawings, that will be deducted and you write the amount in the outer column, rest amount. So in capital, this is the opening capital. This capital is what? This is the opening capital. Capital at the beginning of the year, first day of the year. On that capital you add the net profit if any, or net loss if there, then you deduct the net loss and deduct the drawings. So this is the capital, closing capital. This capital is called closing capital. Then any bank loan you have taken, that is the liability, external liability, bank loan. So write it the bank loan over here, or loan on mortgage, or any other current liability if any, like sundry creditors, bills payable, it's a liability, bills payable, outstanding expenses, unearned income, means income received in advance if any. Okay, any liabilities you have to write in the liability side. Any liability you have to write in the liability side. Okay, or if you have created any sort of reserve, so write the reserve over here. You have created any sort of reserve from profit, then you write the reserve, bank loan, sundry creditors, bills payable, outstanding expenses, unearned income, like this. This side you write the fixed assets. Suppose you are going to write the fixed assets, land and building, it's a fixed assets. Plant and machinery, fixed assets, plant and machinery. Okay, furniture and fixture, any sort of equipment, office equipment, livestock, that is your animal, if any, livestock, goodwill, investment, patents, trademark, okay, trademark, motor car, sundry debtors, bills receivable, accrued income, prepaid expenses, marketable securities, closing stock, cash at bank, if it is a debit balance, and cash in hand if it is cash in hand. So write it this side, this is assets. If bank have a credit balance, then it's a bank overdraft. So write the bank overdraft over here if the bank have a credit balance, or if the bank have a debit balance, then it's a cash at bank assets. And if it is a credit balance, then it's an overdraft, bank overdraft liability. And then you do the total of the both side. Your total must be matched. This total must be matched. Okay, must be equal. So in balance sheet, we write all liabilities this side, left hand side all liabilities, and right hand side all assets. So in balance sheet, which account we are reflecting? Real account. And which account? Personal account. Okay, real account and personal account. So if this real account have a debit balance, then it's an assets, or personal account have a debit balance, then it's an assets. And otherwise, if the real account have a credit balance, then it's a liability, and personal account have a credit balance. So personal and real account will be reflected over here, personal and real account. So capital, opening capital, net profit, you add it, and if there is a net loss, you deduct it, less drawing. So this is the closing capital. Reserve, if any reserve is created, then reserve, bank loan, sundry creditors, bills payable, outstanding expenses, unearned income means income received in advance, bank overdraft, loan from wife, if we have taken the loan from wife, wife's loan from wife, or friend, loan from wife, then you have to write it over here, loan from friend. Then you have to write it over here, loan from financial institution, then you write it in the liability side. So this side your land and building, plant and machinery, furniture and fixtures, equipment, livestock, goodwill, investment, patents, trademark, motor car, sundry debtors, bills receivable, accrued income, prepaid expenses, marketable securities called short term investment, closing stock, cash at bank, cash in hand. So both sides of the balance sheet must be equal, must be same. So in balance sheet, what we reflect? Real account and personal account balance is reflected in the balance sheet. Balance sheet is prepared at a particular date, as at 31st March. Means we are indicating the information on this date, 31st March. This is not for the year. It is on a specific particular date. Okay, and through the balance sheet we know the position of the company. It's a positional statement. We want to know the net worth of the business, net worth of the business. Is it clear? So balance sheet may be presented in order of liquidity and in order of permanency. Balance sheet may be presented in order of liquidity. Suppose liquid assets, current assets are at top and fixed assets are at a bottom, then it is a presentation in form of liquidity. Means liquid assets are at top and fixed assets are at a bottom. Similarly, current assets are at top and current liabilities are at top, and long-term liabilities or non-current liabilities will be at the bottom. Then it is in which way we have presented the balance sheet? Balance sheet in liquidity form. So liquidity form balance sheet, when you are going to present, in liability side current liability will be at the top and non-current liability thereafter, non-current liability. And asset side current assets first and non-current assets next. Non-current assets means fixed assets will be at the bottom. Then it is in the form of, then the presentation is in liquidity form, liquidity in the form of presentation in the form of liquidity. Just opposite in the form of presentation in the form of permanency. Then the non-current liability will be at the top and current liability will be at the bottom. Non-current assets will be at the top and current assets will be at the bottom. So we have to see whether it's in order of liquidity or in order of permanency. So in order of liquidity, current liability will be at the top and non-current liability will be the bottom in the balance sheet. Current assets will be at the top and non-current assets will be at the bottom. And in order of permanency, okay, non-current liability will be at top, non-current liability and current liability will be at the bottom, and non-current assets will be at the top, non-current assets and current assets will be at the bottom. Then it is in order of permanence. Okay, in order of permanence. Is it clear? Now the next topic is contingent liabilities. Contingent liability is not the liability at the time of preparing the balance sheet. This may be the liability in future on happening of certain events. That's why contingent liabilities is shown in the footnote just below the balance sheet, so that the stakeholder or those who are interested to know the company balance sheet in details, they know it that these are the contingent liabilities of the business or these are the contingent liability of the companies. Contingent. This is not the liability at the date of balance sheet, but this may be the liability in future on happening of certain events or on happening of certain things. For example, number one, bills for liabilities for bill discounted. Suppose the business has discounted the bill from the bank. Business has discounted the bill from his banker. So entry is bank account debit, discount account debit to bills receivable. On the due date, if the acceptor of the bill, means drawee of the bill, failed to pay the amount of the bill to bank, then on that case, if drawee or acceptor failed to pay the amount to the bank on the due date, then the drawer is responsible to pay the amount to the bank. So drawer's liability will be secondary. Here, if drawee failed to pay the amount on the due date, then drawer have to pay that amount to the bank. So drawer's liability will come into existence when drawee fail to pay the amount. So if any such bill which is discounted with the bank or any bill which is endorsed to the third party, if the drawee fail to pay the amount, then the drawer become responsible or liable to pay the amount to the bank or the endorsee. So it's a contingent liability. So any bill which is discounted by the drawer on the date of balance sheet or before the date of balance sheet, whose maturity period has not come, then that discounted bill become the contingent liability for the drawer in the drawer books of account. Or if that bill is endorsed to the third party, then also the drawer is responsible or accountable if the drawee fail to pay the amount. So bill discounted, liability for bill discounted and liability for the endorsement of the bill is a contingent liability from drawer point of view. It may be the liability or it may not be the liability. If drawee pay the amount, then it's not a liability. But if drawee fail to pay the amount, then it become a liability. So this information is shown by the business in their financial statement under the just below the balance sheet about the contingent liability. Second contingent liability is your liability in respect of a suit pending in a court of law. Pending in a court of law. Respect of a suit pending in a court of law. If any case is pending, if the case of the business, if the case of the business is pending in the court, no judgment is given by the court till the date of on the date of balance sheet, no judgment is given by the court. It may be Supreme Court or it may be High Court or lower court. No judgment is given. There is a case in the court and the judgment not yet come on the date of balance sheet. So that pending case is a contingent liability for the business, because the judgment may come in favor of the business and judgment may not come in the favor of the business. If judgment come in the favor of the business, then it's not a contingent liability. Then there is no liability. If judgment comes in future, if the judgment comes in favor of business, then there is no liability. But if the judgment come against the firm and firm have to pay certain amounts as a compensation and whatever it may be, then it's become a liability. So on the date of balance sheet, if the case is pending in the court, then it's become a contingent liability. It may be in favor or may be in against the firm in future. So that will be given in the footnotes just below the balance sheet, so that the stakeholder, whether the creditors, bank or financial institutions or anybody else, has to know about the company or to know about the business, that the business have, these are the contingent liability, this may occur in future. So accordingly they will take the decision, the stakeholder will take the decisions. Next contingent liability is liability in respect of a guarantee given for another person. If the business has given the guarantee for another person to the bank or to the financial institution or to anybody else, suppose my friend want to take loan from the bank need a guarantor, and the friend comes to me and my friend come to me and requesting me for a guarantor, to be a guarantor of the bank, requesting me for a guarantor of the guarantor. Okay? Is it clear? If my friend want to take loan from the bank and bank ask for a guarantor, and bank ask for a guarantor, and that friend approach to me and request me to take a guarantee, and I have given the guarantee, I have signed a document. So whatever the loan my friend has taken, that loan has to be refunded by my friend to the bank. If the loan is not refunded or by my friend, or he is in defaulter, then I will be liable to pay the amount to the bank, because I am a guarantor. So if any guarantee is undertaken for another person, then it's a contingent liability. So these are the contingent liabilities for bill discounted, liabilities in respect of a suit pending in the court, liability in respect of a guarantee given for another person. Okay, so contingent liability on the date of balance sheet is not a liability, but it may be the liability in future. That's why the contingent liability is shown in the footnote just below the balance sheet, so that the stakeholder will aware with these contingent liability. So company or the business has to disclose this contingent liability in the footnote, not to hide these informations. Now see the next difference between trial balance and balance sheet. Okay, we have discussed what is trial balance. Trial balance is prepared after the ledger. When the ledgers are closed, from the ledger balance we prepare the trial balance to check the arithmetical accuracy. And this trial balance is helpful to prepare financial statement. Is it clear? So after trial balance we prepare the financial statement, income statement and positional statement, that is balance sheet. Now what is the difference between the trial balance and balance sheet? So difference between trial balance and balance sheet. Come to number one difference, objective. Trial balance objective is what? To check the arithmetical accuracy, that every debit have a corresponding credit is done or not. And here balance sheet objective is what? To know the true and fair view of financial position, to know the health of the business, how much assets the business have, what are the liabilities, how much liability, and what are those liability, what are the assets, what are those assets. So true financial position, fair and true financial position is known through the balance sheet. So objective of both is different. One trial balance objective is to check the arithmetical accuracy, that every debit have a corresponding credit is done or not. Okay, trial balance must be matched. If it is not matched, it means somewhere some mistake is there related to dual aspect or related to another other type of errors. But balance sheet objective is what? Balance sheet objective is to know the true and fair view of the financial positions. Now coming to the next information about profit. From the trial balance we cannot detect the profit. No information you will get it about the profit from the trial balance, because profit information is you will get it from the profit and loss account. Balance sheet, yes, profit can be ascertained from the balance sheet. We can see the profit in the balance sheet because we know that the profit is transferred to capital account. And balance sheet liability side, in capital we add the net profit and deduct the net loss. So information about the profit or loss we may get it through the balance sheet as well. Okay, so it is possible. Necessity, trial balance is not necessary to prepare. It is not necessary. but balance sheet is necessary, it is mandatory. Income statement and positional statement is mandatory. Trial balance is not mandatory. Trial balance is not mandatory. It is not necessary. Headings. When we prepare the trial balance, the format of a trial balance, then there are the 2 columns for the amount, particular, ledger folio, and 2 columns for the amount. One is for debit, another is for credit. But when we prepare the balance sheet, they are the in T-shape form. The left hand side is your liability and right hand side is your assets. So this is the difference. Period. Trial balance may be prepared frequently, maybe monthly, quarterly, as and when required. But balance sheet is not prepared frequently. It may be prepared quarterly, half yearly, or at the end of the financial year. Types of account. In trial balance, all types of account comes personal, real and nominal. All ledger balance related to personal account, related to real account, related to nominal account will be reflected in the trial balance. But in balance sheet, only real account and personal account will reflect. Real account balance and personal account balance. Nominal account balance is reflected where? It is reflected in the trading and profit and loss account while calculating the profit or loss. Closing stock. Closing stock is normally not shown inside the trial balance. It is normally outside the trial balance at the bottom. Okay, and closing stock in the balance sheet, it is in the asset side. It contains in the asset side, reflected in the asset side as a current assets. Closing stock in the balance sheet asset side as a current assets. Adjustment. No adjustment we do it in the trial balance related to prepaid expenses, outstanding expenses, accrued income, income received in advance, depreciation. So no such adjustment is done in the trial balance. But in the balance sheet, we have to do the adjustment. We have to do the adjustment. Without adjustment, balance sheet cannot be prepared. So if there is an adjustment, we have to adjust all this thing in the assets and liability to know the true and fair view of the position of the company or position of the business. Coming to the evidence, trial balance is not presented, not accepted as evidence in the court of law. It is not accepted. But balance sheet is accepted as an evidence in the court of law. Is it clear? Balance sheet is accepted as an evidence in the court of law. So these are the some difference between the trial balance and balance sheet. Is it clear? Now coming to the next question related to the balance sheet. Okay. So draw up the balance sheet of Kesri and Sons. Company name is Kesri and Sons. Company name is Kesri and Sons. So you have to write the name of the company. Balance sheet of Kesri and Sons. Kesri and Sons. As at 31st March 2017, from the following information in order of liquidity. So the information is given: cash in hand, sundry debtors. So we will write the liquid assets at the top and fixed assets at the bottom. When it is in the liquidity form, we will write the current assets, means liquid assets and current assets at the top, and non-current assets at the bottom. In the liability side, we will write the current liability first, then we will write the non-current liabilities. So information is cash in hand. Cash in hand we will write first because cash in hand is most liquid assets. This is the most liquid assets in the business, cash in hand. That is 11,200. You write it, 11,200 cash in hand. Thereafter next is sundry creditors. Sundry creditors is the liability. You write this side, it's a current liability. So current liability will be at the top. Sundry creditors, you write this side. In the liability side, it's a current liability. So current liability is creditors is 28,800. It's a current liability. Next is bills payable. Bills payable is also a current liability. So we'll write it at the top. Bills payable, current liability. Bills payables. Bills payables is 3,500 is the bills payable. You write it. Bills payable. Thereafter bills receivable. Bills receivable is a current assets. Bills receivable is current assets. So write in the asset side, bills receivable. It's a current assets. Means current assets are those assets which can be recovered or realized within 3 months or within the short notice. So bills receivable is how much? 5,300 is the bills receivable. Next item after bills receivable is sundry debtors. Sundry debtors is current assets. Sundry debtors, current assets. Okay, so we'll write the sundry debtors, that is 18,000 is the sundry debtors. You write it at the asset side, it's a current asset, sundry debtors. Next is machinery on 1st April 2016 and depreciation is given. Similarly, furniture and fixture on 1st April 2016 and depreciation is given during the year. And closing stock. So closing stock, we'll write first closing stock. Closing stock is current assets. Closing stock is current assets. So closing stock is how much? It is 15,400 is the closing stock. 15,400 is the closing stock. These are the liquid assets. Cash in hand, bills receivable, sundry debtors is the liquid assets as well as current assets. And closing stock is a current assets but not the liquid assets. So we have written the liquid assets first, and these three are liquid assets and current assets both. And this is not the liquid assets, but it's a current assets but not the liquid assets. That's why I have written at the 4th number. Next is machinery. So you write the machinery over here. Machinery balance is how much? On the first day of the accounting year, machinery balance on first day of the accounting year 2016, it is, you write in the inner column 85,000 and deduct the depreciation charged on it. Depreciation during the year is 8,500 is the depreciation amount. So deduct this and write the amount in the outer column 005. Okay, 76,500. 76,500. Next is your furniture and fixture. Furniture, this is your fixed assets. Furniture and fixture, these two are what? These two are fixed assets, furniture and fixtures. So furniture and fixtures on 1st April 2016, it has given furniture and fixture is 21,000. You deduct the depreciation from this amount. Depreciation on furniture, which is given 2,800 is the 2,100 is the depreciation on furniture. So deduct it and write it in the outer column. Okay, write it. So 18,900. Thereafter you come proprietor's capital, drawing and net profit. So you write the proprietor's capital this side, capital. It's a long term liability. It's a borrowed fund. It's a owner's capital. So it's a long term. So it's a non-current liability. So capital is 90,000. Write in the inner column. Add net profit during the year. we will add the net profit earned during the year in capital, and if there is any net loss, then that will be deducted by us. So net profit is how much? It is 31,000 is the net profit. So we have done the additions. 0, 0, 0, 1, 2, 1,21,000. Then you deduct drawings. Then you deduct drawings from your this amount. So drawings is how much? Drawings is 8,000 is the drawing amount. 8,000 is the drawing amount. So deduct it. So 0, 0, 0, 3, 1, 1, 1,13,000 is this. This is the amount, 1,13,000. Now what we'll do? We'll do the total. Both side total must be matched. Both side total must be matched. So this side total is 0, 0, 3, 1 carry, 9, 12, 12 and 3, 15, 1, 3, 1, 4, 1, 1,45,300. 1,45,300. Do the total of this side also. 0, 0, 5, 4, 9, 9 and 5, 14, 14 and 9, 14 and 9, 23, 2 carry, 3, 8, 8, 16, 16 and 5, 21, 27, 27 and 8, 35, 3 carry, 4, 5, 6 and 7, 13 and 1, 14. 1,45,300. This is the total. This is what? This is the total of the balance sheet. Total. Okay. So this balance sheet is prepared in order of what? In order of liquidity. If it is prepared in order of permanence, then this will be just reverse. This will be just reverse. Means this furniture and machinery will be at top, closing stock thereafter, sundry debtors thereafter, bills receivable and cash in hand will be at the bottom. And this side, this will be at the top, creditors and bills payable will be at the bottom when it is in order of permanencies. Here it is prepared in order of liquidity. That's why liquid assets is at top. These three are the liquid assets and current assets. Closing stock is not a liquid asset but a current assets. So and these two are the non-current assets, fixed assets. So this is at the bottom. These two are the current liability, and this capital is a long-term liability. So long-term liability is written at the bottom. Current liability will be at the top, and non-current liability and long-term liability will be at the bottom. When we prepare the balance sheet in liquidity, in the way of in order of liquidity, and if it is prepared or it is required to prepare the in order of permanence, then we'll do the just reverse. Then in that case, furniture will be at the top, machinery will be at the top, thereafter closing stock, sundry debtors, bills receivable and cash in hand will be at the bottom. Here this will be at the top, creditors and bills payable will be at the bottom. Okay. Now come to the next question. Arrange assets in order of permanence. Okay, arrange assets in order of permanence means non-current assets will be at top and current assets and liquid assets will be at the bottom. So arrange the assets in order of permanence. Informations are sundry debtors, investment, stock, land and building, cash in hand, motor vehicles, cash at bank, goodwill, plant and machinery, furniture, loose tools, marketable securities. So you have to arrange these assets in order of permanency. So this is a balance sheet. Here I am not going to write this one. So balance sheet, suppose it is prepared on 31st March 2020. Suppose it is on 31st March 2020 in order of permanence. Okay, in order of permanence. Okay, going to prepare the balance sheet in order of permanence. Asset side, only the information is related to asset side. So fixed assets will be at the top and current and liquid assets will be at the bottom. So find out the fixed assets. Number one, land and building. Land and building. So land and building, you write it at first. Land and building. Okay. Next is, after land and building, next is motor vehicle. Motor vehicle, it's a non-current assets, it's a fixed assets. Motor vehicle. So land and building, motor vehicle. Another is your long-term assets is plant and machinery. Plant and machinery, it's a fixed assets. Plant and machinery. Okay. Next fixed assets is your furniture. It's a non-current asset, it's a fixed assets. Furniture. Okay. After furniture, next is loose tools. Thereafter, next is goodwill. Goodwill is intangible assets, fixed but intangible. These assets are tangible and fixed assets and tangible fixed assets. This is intangible fixed assets. So goodwill, intangible fixed assets. Goodwill. Okay. Next is your investment. Investment means it's a long-term investment. Only investment is mentioned. It means it's a long-term investment. This comes after the fixed assets and current assets. In between that we have to write the investment, long-term investment. Thereafter you come to the other current assets. Start stock. Stock here means closing stock. Stock here is, it means what? It's a closing stock. It's a current assets. Closing stock. Thereafter sundry debtors, it's a current assets. Sundry debtors, current assets as well as liquid assets. It's a current assets as well as liquid assets. Thereafter marketable securities. Marketable securities is a short-term investment. Short-term investment is called marketable securities. It's a current assets. Marketable securities is current assets. It's a current assets. Is it clear? Current assets, marketable securities. Thereafter you see cash at bank. It's a current assets. Cash at bank, current assets. Cash in hand, most liquid assets. Cash in hand and cash at bank is the most liquid assets. Current assets as well as liquid assets. Sundry debtors, marketable securities, cash at bank and cash in hand is the current as well as liquid assets. Stock is current assets but not a liquid assets. Investment means it's a long-term investment, non-current. So investment comes in between the fixed assets and current assets. The investment placement will be there. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Total 12 items are here. So in this way we will prepare the balance sheet. We will reflect this one if it is in order of permanence. And if it is in the order of liquidity, then this will be just revert. Cash in hand will be at the bottom, cash at bank thereafter marketable securities, sundry debtors, stock, means just reverse, and this will be at the bottom. Okay.